That was the trouble.
And Silicon Valley Bank was broke.
Right.
And those deposits were not guaranteed by the government. So they became a general creditor claim on the failed estate of the bank, as we could formally say, which would have, had it not been for this, in my view, very questionable bailout, would have imposed major losses on the stablecoin. An exact example of the issue that we're talking about.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I am speaking with Alex Pollock, who among other hats is a senior fellow with the Mises Institute, where I also am a senior fellow. So that's how Alex and I know each other. We recently were just at an event together, and I was looking over his recent work and saw that he had an op-ed with Howard Adler. And in the discussion, I have Alex explain who Mr. Adler is, on the Genius Act and some of the risks inherent to it because it's linking stablecoins with the U.S. banking sector, which is not as safe as you might think. All right, so that's kind of the general topic here. And again, I am not necessarily endorsing everything that Alex says, but I think it's a perspective that we definitely need to consider. And just to give you a little bit of his background, he has previously served as the principal deputy director of the Office of Financial Research in the US Treasury Department from 2019 through 21. He was a distinguished senior fellow with the R Street Institute from 2015 through 19, and then again in 21. And also he had been a resident fellow at AEI from 2004 through 15. And then from 1991 through 2004, of particular relevance for the discussion today, Alex Pollock was president and CEO of the Federal Home Loan Bank of Chicago. His bio says there he invented the Mortgage Partnership Finance Program, which successfully created front-end mortgage credit risk sharing beginning in 1997. And his decades of banking experience include being a visiting scholar at the Federal Reserve Bank of St. Louis in 1991. All right, he's got plenty of other accolades here that I will omit in the interest of brevity. But the point is, I think Alex is a very well experienced and trained economist who understands banking and credit risk. And so we should definitely listen to his warnings about the Genius Act and how it is going to interact with the existing financial system. And again, largely just to make sure you, the InFi listeners, understand all the moving parts of this so you can make informed decisions in your own life. So without further ado, here's my discussion with Alex J. Pollock. Alex Pollock, welcome to the InFi podcast.
Thank you. Great to be with you as always.
So I would have already given the folks at home a bit of an intro to your bio, but we're going to be talking about a piece that you co-authored with Howard Adler, and I think it's relevant for the audience to know. Can you just tell a little bit about what your co-author's background is too, so they realize who it is that are advancing these views on the Genius Act and such?
Certainly, Howard and I work together on various things. I am a finance guy, and he is a first-class lawyer. He was a senior banking and regulatory lawyer in Washington with the firm of Gibson Dunn. So this combination, it seemed to us, was good for dealing with a new law on the nature of stablecoins and its financial and implications.
Okay, great. And so, and also the thing I saw was was a real clear op-ed or article, but then you said you guys also submitted something that was more formal to the Treasury?
We did. We took the same ideas, but put it into more formal language in a comment letter to the Treasury, which has asked for comments on financial implications of the Genius Act, as it's called. So that is also on the public record.
Okay, great. So we don't need to do too much in terms of the big, like the basics, because here on this podcast, I think I've mentioned to you, Alex, I've been going over this for some time now. So the folks at home have a good idea of, they know what stablecoins are. They know what the main elements of the Genius Act are. But what I found intriguing about your guys' article was you made several points that I just want to walk through here. So I think the first big one you made was to say, hey, just because it is requiring that, among other things, that stablecoins have to be backed up possibly by bank deposits, public might think, oh, that's pretty safe. And your point was, no, not necessarily.
That's correct. I think we point out in there a couple of thousand banks have failed in the last 50 years, and bank deposits are not necessarily safe. That's why many people think for the general public, you have to get the government to guarantee them, so-called insure them, is really a government guarantee because they are inherently risky. So what we point out in this article is that virtually all of the public conversation of the Genius Act has talked about how stablecoins, how the proceeds of the sale of a stablecoin will go into treasury bills, into short-term US Treasury securities, treasury bills. But in fact, that isn't what the law says. The law said, well, you could put it into treasury bills, but you could also put it into bank deposits. And these deposits, if they're large, will be uninsured. They will not, unlike a treasury bill, they will not be a U.S. government credit. Now, whatever you may think of the credit of the U.S. government on an absolute scale, on a relative scale, it's good. And to put it in an unsecured deposit of a bank is a much riskier and very different financial proposition that, in fact, ties the risk of the banking system into this new developing stablecoin system in a very serious way. And bank deposits that are uninsured are risky. Banks do fail. They fail fairly frequently, historically speaking. And lenders to the banks, which is to say depositors, to put a deposit in a bank is making a loan to the bank. They are at risk in the event that the bank itself makes bad loans or makes a bad interest rate mismatch and fails for one reason or another. As we have said, has happened many times over the last decade. Most recently, we had a banking crisis in 2023. And in fact, one of the large stablecoin issuers, Circle, was caught as an uninsured depositor in the failure of Silicon Valley Bank and would have had extremely large losses on its deposits in that bank had the bank not been, in my view, egregiously bailed out by the government, which made other people pay to very wealthy depositors the full value of their deposits when they should have lost money. But anyway, there's a very recent real-world example of the riskiness of being an uninsured and, by definition, unsecured depositor in a bank, which gets in trouble and fails.
And I just want to clarify, most people probably knew this distinction, but in case people are getting confused, even if you're at a bank that has like the nice FDIC, logos on it and stuff that, if you're just a regular depositor, you get your paycheck every 2 weeks or whatever, and you go get your grocery, you're falling well below the $250,000 limit. And so, yes, your deposits are insured by the federal government. But the point is, if some other stablecoin issuer banks at that same bank, presumably their checking account, or even if there's multiple ones with that, are going to be well in excess of $250,000. And so that portion is not protected by FDIC. And that's
could be millions or tens of millions or even hundreds of millions of dollars. Definitely not protected. Now, what the Act says is deposits in an insured depository. Well, the fact that the bank is insured does not mean your deposit is insured. If it's a large deposit, it's not. And you're at risk in the event of the failure of the financial institution. You're just a general creditor out there. You get some recovery out of the assets of the bank, which, if the bank has failed, means by definition, if it gets liquidated, you're going to be suffering serious losses.
It was ironic reading your guys' piece because, again, you sort of flipped it, that I've been in lots of conversations with people like in the blockchain space about the implications of the Genius Act. What does this mean? And I'm here there as the economist. But you're right. Most people, when they read the Genius Act, they sort of skipped over the bank deposit part because to them, like, they, that's just money. That's like a phrase we use, colloquialism, money in the bank.
Yeah.
It means it's safe. And then the next thing they were talking about was the treasury element. But you're right that there's a sense in which, certainly compared to like T-bills, no, money in a checking account, especially like you say, if we're talking about the checking balances that are in the millions of dollars, there's a sense in which that is much less safe than T-bills, because the commercial bank is certainly not taking your millions of dollars of deposits and going and roll them into 3 months T-bills over and over. That's not what they're doing.
That's right. If you look through to the ultimate assets behind this claim of the stablecoin, you're absolutely right. A bank may own a few T-bills, but not principally. It's a very small part of banking balance sheets these days. And the bank may be making any kind of loan. They might be making quite risky loans. They might be making commercial real estate loans that get in trouble. They could be making foreign loans all over the world. They could be making subprime mortgages. They could be doing anything with that money. So it's a completely different form of risk. And even the White House announcement, as we point out in the article, Bob, stresses, oh, well, this money is going into T-bills. But that's not what the act says. It said it can go into T-bills, but it can also go into bank deposits. And those bank deposits, depending on the bank, might be a lot riskier. And in any case, they are riskier than T-bills. So there's another aspect of this which is very important. And that is that these are not limited to domestic banks. These deposits may also be in foreign banks. And a deposit in a foreign bank, depending on the country and depending on the bank, riskier than T-bills, but it could be a lot riskier than T-bills if you have banks, let's say, in jurisdictions which are not noted for their particular conservative risk profile. So there's the issue of uninsured deposits in banks. And on top of that, of uninsured deposits in foreign banks. Now, what the act says is the bank has to be a correspondent bank, that is to say, a bank with whom a U.S. bank can be any bank in any country.
Okay. Let me just reiterate something. You did make the point, but I want to make sure people caught it, that this isn't merely a theoretical concern that you guys are raising, that what happened back in 2023 when Silicon Valley Bank, among others, got into trouble, among the fallout was Circle. So it issues the USD coin, Circle coin, and USDC, I should say. And you quote from a press release at the time saying that Circle, obviously it's USDC supposed to trade at par, and it fell below 87 cents. And the reason was that 8% of its $40 billion in reserves were actually held at Silicon Valley Bank. So clearly that's well in excess of $250,000. And that was the trouble they got in.
Silicon Valley Bank was broke.
Right.
And those deposits were not guaranteed by the government. So they became a general creditor claim on the failed estate of the bank, as we could formally say, which would have, had it not been for this, in my view, very questionable bailout, would have imposed major losses on the stablecoin. An exact example of the issue that we're talking about.
And ironically, this kind of ties in, Alex, to the conversation you and I have had elsewhere on different podcasts about the Federal Reserve and what happened with them. Is Silicon Valley Bank, the reason they were in trouble, it's not that they were invested in all sorts of like crazy derivatives and things. Like a big deal was they were sitting on longer term treasuries. And then when the yield curve rose, they were in trouble just because of that element too.
They were upside down, as we say. That is to say, the costs of funding were going to be greater than the yield on the assets. But I will note, their actual biggest investment was not treasuries, it was mortgage-backed securities. Very long-term, 30-year long fixed-rate securities. And they had a position against those securities, which was funding them with short-term deposits. That's as elementary a risk problem as you could get. That's really banking 101. Not to do that, but somehow everybody went along with it. I do say that the same risk position exists in the Federal Reserve banks itself. And that's why the Federal Reserve banks in the aggregate have so far lost over $240 billion. They did the same thing that Silicon Valley Bank did. Or you could say Silicon Valley Bank, in its own defense, might say, well, we're just doing the same thing the Federal Reserve is saying. I call this the Federal Reserve as the Pied Piper of interest rate risk here. So that's a related but very serious problem. And the problem, by the way, it wasn't just one bank. There were many banks around the country that did exactly the same thing. And they had, on a mark-to-market basis, by one analysis, there were $2 trillion of markets in the financial system as a whole, because they did the same thing that the Pied Piper of the Federal Reserve did and suffered very large financial risks and depreciation of their assets at market value accordingly. And that was one of the things that people were afraid of, including the government in 2023, was that these runs from Silicon Valley and First Republic and so on would spread to many other banks because they all gave position and suffered accordingly.
Well, yeah.
So again, this is not a pure theoretic. This is not a theoretical question. This is a very real question of the credit of the bonds themselves, which is a very different and riskier issue than the credit itself. Again, nothing is risk-free in finance. The United States government is not risk-free, but relatively speaking, it's much less risky than an uninsured deposit in a bank.
Well, yeah, I was actually going to come and ask you about this stuff when I knew we were going to talk about SVB a bit. So why don't I just go ahead and jump right into it? Can you give us, because you're right, at the time, I remember, when SVB and these other banks were in trouble, seeing those estimates about the unrealized losses that the banks were carrying with their fixed income as interest rates rose. And there are people warning, hey, this is a ticking time bomb. And I think a lot of people in the financial sector are going to say, yeah, well, nothing really happened. The world didn't blow up. And so you guys are Chicken Little. Like, could you just have any more explanation? Was it just some of the banks are just holding it to maturity and they kind of got through it? Or what, you understand my question?
You can hold to maturity doesn't mean you avoid the losses. What is often said is, oh, well, just hold it to maturity. Actually, the Federal Reserve has argued this in defense of its own risk position. Just hold the maturity and we'll get our principal back at maturity. What that doesn't take into account is that in the meantime, you're losing money every day, cash money, operating losses, because the cost to finance your position is greater than the income on the position. Now, one of the reasons why this time it wasn't as bad as the direst predictions was the banks managed to hold the cost of their deposits down. I call this cheating the savers. If you can cheat the savers enough, you can not realize through ongoing operating losses the full extent of the mark-to-market loss, because the mark-to-market assumes you're paying market rates, that everything is being calculated at market rates. And in deposit markets, as people have pointed out, and they're right, the deposits don't necessarily pay market rates. You should maybe think that depositors need to wake up a little on that one. But it nonetheless is the case that the banks can get away with suppressing, and of course, the regulators who care about the safety of the banks play along with this game, suppressing the returns to savers in order to keep down the losses to the banks. And we know that as good students of Austrian economics, we know that central banks are tricky. And one of the things central banks do is force losses on savers in order to bail out speculators and financial institutions. And we see another case of that here. But the risk is very real in a case, a very important parallel case, which is the savings and loan collapse of the 1980s. There, savings and loans, old style. By the way, not only with the encouragement of the government, but of the requirement for the government required by law the savings and loans to make long-term fixed-rate mortgages, and they were financing them short. Well, nobody imagined that interest rates were going to go up the way they actually did. They were not able to suppress the cost of their deposits enough, and more than 1,000 savings and loans failed in the decade of the 1980s, and the whole industry collapsed and basically has been absorbed into the banks. There is no more savings and loan industry to speak of. And the deposit insurance fund, by the way, of the savings and loans, which was the Federal Savings and Loan Insurance Corporation, known in its day as FSLIC, for those who are old enough. That was a government deposit insurance organization. It itself went broke. It couldn't pay its promise to protect the deposits, so it got bailed out by the Treasury. And you, if you are a taxpayer listening today, in order to finance that bailout, the government sold 9% bonds in about 1989, 1990. Those bonds run to 2030. So you, my taxpayer colleagues, we are still paying for the S&L bailout for 5 more years until 2030. And that was a 1989 bailout. So this kind of risk, Bob, what I'm just trying to elaborate on, this is very real, not a mere theoretical idea. It's theoretically correct, but it's also a very real problem.
Am I right in thinking that what happened when we think of the S&L crisis, there were at least 2 big things going on, like the interest rates rising rapidly in the late 70s and early 80s, that famously Paul Volcker comes in and break the back of inflation, jacks up interest rates. Is that one thing that like really would upset that business model where you're borrowing short and lending long?
Didn't just upset it, it destroyed it.
Yeah. And then
for the S&Ls.
Okay. So that, for people to understand, like, geez, how come all of a sudden in the early 80s there was this big crisis? Like that was part of the issue.
Well, savings and loans failed in the 80s. But how many commercial banks failed during the 1980s? The answer is more than 1,000 commercial banks. In the 80s, they also had interest rate risk, but there were a series of credit collapses. There was the collapse of foreign sovereign debt. We called it the less developed country debt problem in those days. Now it would be called emerging country debt. But that collapsed with huge losses to the banks. Oil, there was the oil bubble, which collapsed. There was a farmland credit collapse. And so the banks, forget numbers, failed, as I say, more. And those were exciting times, but they're not unique. This happens cyclically. And one of the things you don't want to do is to pretend that making deposits in banks is not risky. That leads to making mistakes. You have to understand it is risky because what the banks themselves are doing is risky. And it isn't, as you point out, buying T-bills. At least buying T-bills is a very small part of what the banks are doing.
Great. So let me read to you a paragraph just as we're talking about this in the connection with the savings and loans. So, this is implicit in what you said, but I think an elaboration. You said the law talking about the Genius Act, the law permits a subsidiary of an insured financial institution to issue stablecoins. No provision of the law would prevent the subsidiary from holding its reserves in uninsured deposits at its own parent bank. This creates a very favorable business model for the banks, whereby the bank subsidiary issues the stablecoins on which the Genius Act prohibits paying interest, and they could charge a fee for the issuance. The subsidiary could then deposit these funds as reserves in its parent bank in a non-interest-bearing deposit. The bank could then use these funds, which are free money to the bank, to make loans or buy securities, just thus enjoying a very profitable spread. And then you liken that to what was part of what was going on with the S&Ls. So can you just unpack that a little bit?
Yes. Well, we have 2, in addition to the general problem, which is investing in a riskier class of assets than Treasury bills, unlike, as I say, almost all the discussion. You can imagine 2 cases, and we do imagine it in this op-ed. One is the case where there is an existing bank and it sets up a stablecoin subsidiary, which is a very important part of the bank, a part of the act, a very important part of the Genius Act to allow that. That stablecoin subsidiary issues stablecoins to the public, supposedly backed by these very pristine assets. But instead of buying T-bills, it just makes deposits in its own bank. Now, the bank has in effect created interest-free funding. It's on a consolidated basis, issuing stable coins with no interest. And what does the bank do with the money now? Well, it does anything it wants. It might do something very smart and very safe and very profitable, but it might do something very risky that ends up badly. It could make any kind of loan. It can buy any kind of securities allowed to banks. Why are banks so heavily regulated? Well, one reason is because the fundamental business of lending money into an unknown future is a risky business. So that's a key way that you could get a lot more risk out of the structure than you think. The other way is perhaps even riskier. There we start with the stablecoin issuer. Now, the stablecoin issuer says, great, I can get these stablecoins in the hands of the public. Well, I could just buy T-bills with them. But how about if I set up a bank? I'll just set up a bank and I'll make my stablecoin issuer a subsidiary of the bank. And I'll just take the proceeds of the stablecoins and put them in my bank. Now I have the same thing. Now I can do anything that's permitted to a bank, not far from the conservatism and safety of buying T-bills. I can do anything. And I've got, you can imagine at least, the situation where it's all controlled by private parties. They own the bank and the bank owns the stablecoin issuer, and the stablecoins are now generating funding to that bank to do whatever it may do, whatever may be able to get past the regulators. And we point out there that there is an analogy from the same savings and loan history, was that it used to be that it was a great idea for real estate developers to set up an S&L and control the S&L to do what? To finance real estate loans. Well, real estate loans are okay if you do it right and carefully with wide margins for safety. They still get into trouble. Almost every financial crisis has real estate loans as part of it, part of the crisis. But you could also make real estate loans which are very risky and result in collapses, and they are far, far from the risk characteristics of buying a treasury bill. So there are two ways. You might say we're thinking about, I'm going to say 4 cases. The stablecoin issuer is investing in other banks, in unrelated banks, but they're still investing in a riskier asset. Second case, not only other banks, but other foreign banks. Maybe it's putting money into the British Virgin Islands or Cyprus, who knows where there might be much riskier stuff going on. So that's not only domestic banks, but foreign banks would be case 2. Case 3, the bank itself sets up a stablecoin subsidiary to fund itself and do whatever it's doing, which will mostly not be buying T-bills. Or case 4, might be the trickiest one of all, the stablecoin issuer itself sets up its own bank to become the parent company of the stablecoin issuer, and then the stablecoins fund whatever that bank is doing under the control of the stablecoin entrepreneurs, so they really get a much freer hand, let's say, much more than anyone is imagining, if what you're imagining is buying T-bills. We think there's a pretty serious issue with the macro finance or the systemic risk issues involved with stablecoins.
Well, that's great stuff. And let me just relate it, Alex. The reason I loved your piece and I want to get you here on the podcast is I was cynical. When the commentary I've been giving is that it looks like the bankers behind the scenes wrote a lot of the Genius Act to protect their turf. And then what you just said there made me realize, no, even I wasn't being cynical enough that, well, maybe that's not the right word, but seeing the possibilities. So let me just...
Let's call it politically realistic.
Yeah, okay. So I wasn't entrepreneurial enough, right? Because my original take from looking at the provisions and everything was to say, okay, yes, obviously as an Austrian economist who's familiar with the problems of fractional reserve banking and so on, maturity mismatch and so on, I said, I can see the logic in this insofar as it goes. They're saying, hey, there's burgeoning stablecoin market. A lot of Americans are going to come to believe that this is, quote, as good as dollars online. And so
risk-free, as they say.
Right. So to protect the public for people who think that, oh yeah, having a bunch of money in my wallet of stable coins is the same, at some exchange or whatever, is the same thing as having money in a checking account somewhere. And so to make sure the public doesn't get burned, so the ostensible justification for the Genius Act provisions would go is to say, yeah, we don't want some private company out there that's outside conventional banking regulations to just be taking people's deposits, giving them stable coins, saying, oh, these are tied to the US dollar, and then going and putting it in who knows what. So instead, we're going to say, you got to keep it in really liquid, safe stuff like T-bills. And so, okay. Or, you could put it in a bank, an insured bank. And so that gives the illusion that these things are super safe. And so my sort of cynical comment was, and they prevent paying of interest. So that kind of ties the hands of the stablecoin issuer that, yeah, you don't need to worry that they're going to put in stuff yielding 12%, that if they're not paying interest, then they can make their model work. They can afford to just put it in T-bills because they can't even pay any interest through to the customer. But what you're showing here is it's even better than that because, yeah, they can go ahead, issue the stable coins, not have to pay interest on it. But then as long as they go through a bank, then they still can go and invest it in the other stuff they want and earn the higher yields than just having it roll over in T-bills. And so it's like they get the best of both worlds.
Of course, it's the best of both worlds until it isn't, until there's some problem.
Well, right.
Like, 2023, not that long ago.
Yeah. I mean, not the best of both worlds for all parties, but yes. So anyway, it was just interesting. I said that you were sort of completing the circuit. I was just seeing how, because you could, I mean, where this was going, and if it had sort of been unregulated, is there would have been firms basically just tokenizing treasuries and passing that through to people in digital form. Like to say, you can hold our stable coins, but if you keep your balance over time, it'll grow, right? So in other words, if they got it in T-bills that are rolling over, whatever, 3%, and you got 100 such coins in your account with them, it grows to 102 coins next year if you just leave them parked there. So each coin's still $1, but you could imagine business models like that. But no, that approach is not allowed. And so I thought, oh yeah, that's because why would you bank? Or you could see how the big banks would be worried people will migrate into that thing if paying interest is allowed. But anyway, so that's what I'm just saying is I realized that with your piece that yes, to the extent that banks and stablecoin issuers merge behind the scenes, there is this sort of thing that, oh yeah, that wall of the bank and it's an insured bank. That makes it seem like any money going in and out all of a sudden becomes magically protected when, as we've been stressing, no, it's not.
You are so right. Nicely stated.
Well, thank you. So we've sort of walked through all of the issues you guys raised, and I suppose somebody would say, and this will be the last question I'll pose to you here, Alex. Okay, well, suppose people in the Trump administration or Congress, they see these concerns, and do you recommend that they tweak things going forward? Like, do you have ideas of how this could be done in a smarter way?
If you think about one of the principal objectives, apparently, of the Trump administration in this and the Treasury, it is to force stablecoin issuers, or to seem to force stablecoin issuers, to buy more Treasury bills. So the governments, of course, always wish to encourage people to buy their own debt. And if you take the surface point of view that a stablecoin is a T-bill, well, now if you got a lot of people putting money into stablecoins, and this is similar to what the White House information publications said, well, now we're going to get more people buying Treasury securities, namely these T-bills, just at a time when maybe other people, or say foreign central banks, are becoming less interested, at least some of them, in buying T-bills. They want to buy gold instead. So you see this urge from the administration point of view to create a market for Treasury debt. By the way, as a historical footnote, this is exactly what the Lincoln administration did when, during the Civil War, it signed the act of Congress creating the national banks. And the national banks could issue currency, that is to say dollar bills, as long as they invested the proceeds in government bonds. So it was in fact a way to finance the government and finance the Union armies in the Civil War. Very clever. Well, there's a similar thought with the stable coins. We'll create these stable coins and it'll finance the government. But this issue that you and I have been talking about raises that as a question. Well, will that really work? Why wouldn't it make more sense for the stablecoin issuers, since they can, to hold bank deposits, maybe get paid more for the bank deposits and be able to reap the higher yields from the higher risk assets that the banks are investing in? So if you really wanted, from the point of view politically, from the point of view of the administration, to more successfully make sure you were getting this money into Treasury securities and instead of bank deposits, why you might want to amend this accordingly. Of course, there would be the very people who were working on getting this bank alternative into the act. That's how it got there. Will not be happy if you try to change it. And so we come upon one of Pollock's foundational principles, which is there's no such thing as finance. There's only political finance. And that's certainly the case here too.
Well, that's a great note to end on. Similar to Murphy's Law, which we'll hope. So thank you so much, folks. My guest has been Alex Pollock, who is, among his other hats, is also a senior fellow with the Mises Institute, where I also reside. And so thank you, Alex, for all the work you've been doing and for your time here to explain to us.
Thank you, Bob. It's really great to be with you, as always.
Thanks. And thanks, everybody, for tuning in. We'll see you next time.